You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
You know, you're right. And I think most people at this conference, a lot of people listening to this show too, I think would understand that the point that they've been beating the drum on so much about the markets being rigged is demonstrably false. You know, no one's front running the grandma from Iowa buying 50 shares of IBM. That's absurd. They want those people to come in. They're filling them. That's where we're getting their fills from. I mean, those people are, and you're right, the commissions, everything else, there are so many demonstrable points that those people are doing better as a result. He makes some other points in the book that I think are a little bit more salient and aren't getting anywhere near the traction that the markets are rigged nonsense is getting. And it's a bit of a shame because he makes some interesting points, kind of getting back to what we were talking about a little bit earlier regarding different aspects of payments. He talks about maker-taker and some of the issues with that and payment for order flow in general. He raises it like it's a new concept, like people haven't been debating it for about 20 years. But be that as it may, 15 years in the options market. And he also makes some interesting points, I think, about the ownership structure at the exchanges, how there's a lot of other people buying ownership interests in the exchanges, even in the option space, and how that's kind of the way business has been done in the options world for the better part of the last decade. If you're going to launch a new venue, you better sell a piece of it to an order flow provider or someone, otherwise they're not routing to you. It's just kind of the way the business is. I'm curious to you what your take is on those latter points that are a little bit more salient to options and might have a little bit more legs to them in terms of payment itself and the structure we're seeing arising around these firms, if it does indeed, you think, cause a conflict of interest.
Well, I know, Mark, you and I talked about payment 10 years ago, and it was beginning to be a pretty hot topic in the options market because I think prior to 2004, a couple firms were doing it, and it really wasn't above board. And then later, 2005, 2006, the SEC, started to recognize it and say you have to have filings and post them on your website and things like that. And I do believe you and I may have been coming at this from a little bit of a different point of view. Not to say that we couldn't disagree on things, but my view on payment for order flow in the options world is that as long as the customer is benefiting from it somehow, it's actually a more natural progression of things. Meaning, as you know, and your listeners know, when I trade on my bid or ask, if I'm doing my job properly, I'm catching some edge. I'm getting some initial edge. Okay, of course, I've got to hedge it and manage it and exit the position to keep that edge. But unlike in the equities world or in futures world, I hate to say it, it's a greater fool theory in those markets where when you buy something, unless it's a piece of a puzzle of a portfolio that you needed to fit in, you're not making money automatically when you trade, whereas in options, you have a running start if you get that edge. So you want to trade on your bid and offer. You should not have to be incentivized to trade on your bid and offer if you're making the proper markets. So now comes the payment part. I'm willing to share a little of that with you as the customer, meaning I would rather have a 5-cent wide market and pay you 50 cents to hit my bid or whatever. And that's the difference in tightening the markets. So as long as it's managed above board, which we do have today, exchanges administer them, and somehow the customer gets the benefit. Now, Schwab and Fidelity and TD and IB and all these firms, they've lowered all their rates. It's not a one-to-one, where they pass that money on directly to the clients, but they've lowered all their rates from where they were 10, 15, 20 years ago to their customers. So customers are trading for a lot less. And not high frequency, but active traders who trade a lot are trading even lower. So if you're really pounding it, these firms are giving you a better break. And that's because they're getting the liquidity providers to share a little of their edge with them. So I've yet to see how that isn't a natural progression as long as there isn't some slippage to get it back to the customers. We collect payment for order flow on some of our customers, and some of our customers we just hand it all right back to them, and others our arrangement is your rates are lower. We might even cap you or an all-you-can-eat type thing, and we take our chances with the payment for order flow. It shouldn't be such a scary thing to talk about, and if the regulators really understood it, and somebody can correct me if I'm wrong in terms of understanding what market makers do when they trade against the order flow, then you have a natural flow of a little value from me back to you to trade with me, and everybody should be fine.
So that must surprise you then when retail-heavy firms and even individuals like Charles Schwab come out so stridently against HFT and payment when a firm like that has been collecting quite a bit on the payment side. It is a bit of an interesting argument to make.
Yeah, and I don't know why they do that. Maybe they're out of sync with their PR department or now in the option space. And I'm speaking only about option space because in the equity space it is different. In the option space, I know that Charles Schwab and Fidelity and others de facto do share that gain by tremendously lower rates to their customers. I mean, I don't know what the market should be for an options contract with a retail broker, but they're very, very competitive today. And compared to when I started, it would cost you $50 per contract for brokerage, to trade an option. And you had to really cross your fingers the stock would move in your direction for a long time before you get to break even. So to have them go from, in the late 90s, it was down to $25 a contract to down to 25 to 75 cents a contract. It's pretty darn good.
Your own group, BNY ConvergEx, did some research on this, and it probably tends to indicate this came out late April, so it probably indicates how pervasive the reach of flash boys already has been. They surveyed a number of, and this is not just talking to retail, this is talking to financial industry participants about this exact topic, high-frequency trading, and they said that a majority of their respondents believe that U.S. equity markets are currently not fair for all participants, 70%. 70%. HFT is harmful to market participants, 51%, so a slight majority, but a majority. And despite these concerns, almost three-quarters of respondents, 71%, report that they have not made any changes to the way that they interact with the market. So apparently they're not motivated enough to do anything about it, which is odd. But still, even your firm surveying people who ostensibly know the markets fairly well are clearly very concerned about this somehow disenfranchising them or disadvantaging them in some way, shape, or form.
Right. So we had over 190 clients come to that event last week. It was very well attended. We had a pretty august panel to discuss these things, and we did this survey. And, predominantly it was equity traders. That's what we're sticking to in that venue. And 71 or whatever that was, 72% of the buy-side clients, because we had some sell-side clients and some journalists there, but of the 150 or so buy-side clients of ours that were there, 71% said that they thought the markets were unfair to somebody. It wasn't fair to everyone. It wasn't equally fair. So the thing about polls are, your results are really based on how you word the question. And it's hard to get a question. I thought that question was worded fine. But depending on – and I thought about it. Wow, they're not doing anything about it, but they don't think it's fair. Well, fair is a pretty broad word.
It might mean I think it's fair for them. That's true, and not fair for everybody else.
Right, exactly. So, we always used to say that, Goldman was government Sachs, and we thought that they – had an unfair advantage. And I think some of the actions over the last 6 years from the debacle in 2008 have shown that they had a little hat tip, a little nod from the government to do things, because of who they are, and they're big. So, yeah, it's not as fair to me as it is to a Goldman trader because he's got more tools and more wherewithal. But generally speaking, the markets are very, very fair. They're the fairest in the world. And then if you want to get relative, what's the alternative? I mean, the bond market is clouded with hidden dealers and, obfuscated bids and offers. So I think that group that we had a great session with last Thursday, a week ago today, pretty knowledgeable people, but definitely not interested to make changes because it wasn't that bad. Maybe it wasn't as fair as they could imagine, but it wasn't that bad.
Yeah, if it was demonstrably impacting them in some way, you think they would be motivated to
do
something about it, or you're right, or shut up or shut down their shop. One of the other controversial topics he raised in that book was dark pools. Not as much of a relevant thing in the option space, but it does apply to you guys in a way because you guys just launched a new product playing on that dark nomenclature, the new dark NXP dark algorithm. This kind of gets back to what we were talking about a little bit earlier about legging some spreads and finding some liquidity in some areas where maybe people wouldn't normally look. Why don't you go ahead? I'm probably doing it a disservice. Why don't you give us an overview of what this dark algorithm
that's great.
is and what it can do for it?
I really appreciate it, Mark, because you did a great job on that. So what NXP, how we got the name, when there were 5 exchanges after the ISE launched, we had what we called the 5th Exchange, and then the box launched, so we called it the 6th Exchange. And over the course of time, about 7 or 8, we gave up and just called it the Nth.
Stop adding the numbers.
Yes, so we called it the Nth Exchange, and we shortened that to NXP, which stands for Nth Exchange Process. And what we do, we are the only certified options ATS. Most of your users wouldn't know that there's an options ATS in the marketplace. Unlike an equity ATS, we don't have trade reporting facility rights. In other words, all of our trades have to go to an exchange to be printed. Okay? So what NXP does is it exists as a liquidity source for broker-dealers that may or may not be members on all the exchanges. They're exposed through an RFQ, our flow, and this all happens in sub-millisecond time. Before that order goes to an exchange, it's exposed to the NXP RFQ. The responders have a file on hand where they know what they want to do. They have to quote. They don't know which way the customer's going. They know the size in the strike, the underline, of course, month, but they don't know the direction, and we rip off the side that's the contra, put it in the PIM AIM pixel, whichever is most advantageous crossing facility, and our flow has enjoyed. We rate the liquidity on a scale of 1 to 100, 100 meaning 100% meaning every time that order is taking the posted bid or hitting the posted offer. A 90 would mean 10% of the market width has been saved. We have been coming in with 57%. So we've got users in NXP, and then the crowd step up in the marketplace to join the exchange process, the crossing process, to the tune of some days almost pick-em markets for our customers. So it's all on the exchange, but this looms out there. We're certified ATS. We have extra regulations, more filings and everything. It's all transparent. But our users, our clients, get that first bite of the apple before it goes to the marketplace, and then the market makers jump in, and we get broken up, but it serves for added liquidity. And what that press release is that we just signed a deal with Octant for all their market makers. They have 30-some market makers using their software. We're going to be a destination on their platform like an exchange.
So that speaks a lot to what we were talking about earlier, some of the issues with spreads and legging between exchanges, and also the technology and fragmentation. If these vendors and these traders don't want to have the hassle or expense of connecting to a myriad of different venues. They can go through this NXP instead and still get access to a lot of liquidity. But again, because it happens, like you said, in sub-milliseconds, they're not going to be left out there. Someone can lean against them all day. They can get it all done pretty quickly. So it seems like it's pretty advantageous. And it kind of gets to what we've been saying a lot on this show, that it seems like a lot of the solutions to the issues we're seeing in the space are popping up in the third-party vendor side rather than the long arm of regulation coming down with all of the myriad unintended consequences that we're all enjoying right now.
You can also look at it as a feeder program, or a minor leagues, if you will, training camp, where if you want to try out your market making ideas, I mean, it's quite expensive, right, to become a member. And you mentioned this, Mark, and I think this is an issue that maybe for another show totally, and that is the demise of the market maker. You know, how many have fallen over the last 6 years due to a number of reasons, but it's expensive and it's difficult and the regulations and on and on. But there are people who want to do this, and this is the thing that makes the U.S. markets different than the other markets, because we have lit screens because of our rich tapestry of market-making skill sets and market-making firms. But there's less than half today than there were in 2009, which is really sad. So the NXP process allows a young broker-dealer to come in and start trying their hand with their systems and grow up and become a member at one of the exchanges, so they get full-on access to a lot of flow. So it serves in multiple purposes, I think.
And what kind of volume are you pushing through the NXP these days?
It's about 250 to 300,000 contracts a day today, some spikes. So, it's about 5-7% of the total flow that we handle. Now, a lot of the flow we handle comes down packaged already, and goes right into the crossing facilities, so we wouldn't have a shot at it. But it's about 20% of the flow we control ourselves, so we can route closer to about 15%. We have about 2 million contracts a day that we can have discretion on where we route it to, and we're doing about 250 in NXP.
It's more volume than some of the new entrants to the space.
Well, right.
Just putting up. One last thing I want to touch on here, Tony, is we know the live vol guys pretty well. We've had them on the show a number of times. I've watched that firm kind of grow and evolve over the years. You guys just announced a big partnership with them. What was the genesis of that? Why did you guys get together?
Well, so Live Vol has a fantastic product, and it's deep and rich feature set for sole props and small shops. It's done a great job over the years delivering, big company type of value. The problem is the company as an entity is a small company, and their CEO reached out to me late last year and said, listen, we have a lot of shops that say great product, but you're a small company. They literally have like 15 employees. You need to have a little more gravitas, and we would do business with you. And our name came up a number of times with some of these shops. So we got together. We structured a sales and support program where my guys and gals will be making available to our customers Live Vol. They have Live Vol Pro, Live Vol X, and the core product, which is more for retail. It's a web-based product. The Live Vol folks were in last week, and we went over everything. It was just awesome data, awesome product, and my team will be selling it and supporting it. So now we have a handful of large clients that have said okay, because they're used to our service and support, and this will give Live Vol a chance to close those deals that they were having a problem closing with. So it's exciting, and we're doing an integration. We're just about certified. So on Live Vol, you can get our pipes. I would say challenge any of you competitors out there to do a time test with us. We're the fastest pipes on the street for options, and that integration is just about done. So when you get Live Vol, you also have an opportunity to use Liquidpoint routes.
Seems like it's a pretty good marriage then, because you're right. They've always lacked that penetration into the institutional space, as well as a dedicated sales team to help them get there. You guys can provide that. They can provide some more data, some more analytics, as well as also, like you said, that more retail friendly on the pro side and everything else that they have that you guys don't have.
We have just never, we have the expertise. We have such a pipeline. Our product roadmap goes out 3 years to get to the analytics and the data that they provide. So it's just a really good marriage. I'm really excited about it. Kathy Clay's a wonderful person to work with, and we're just kicking it off now, and so keep your fingers crossed.
Well, it's exciting things. A lot of stuff coming out of Liquidpoint these days, Tony. Before we wrap up here, because that's pretty much all the time we have, anything else you want to leave our listeners with, any hints, any teases or things that are coming down the pike for you guys?
Well, we can't tease too much, but we do have another large deal that we're going to be announcing here in the near term. It's more for the institutional client, though, but it's really going to try to revolutionize the CMTA side of the business, which is a big morass, and it'll help the industry. I think it'll lower costs for everybody in general, but we've been at work for a while. We'll be probably announcing it in May. But I'm really excited for the industry. I think the growth will continue, and I'm happy to be involved.
Well, Tony, I'm very glad we can finally get you on the show. It took 7 years. I don't know how that happened. It was an oversight on our part. We'll definitely have to bring you back on more often, as well as check in more with what's going on over there at Liquidpoint down the road.
Thanks, Mark.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.